Welcome to the Deep Dive. Put away your blue chips, your dividend stocks, and definitely your portfolio anchor.
Struggle slightly, yeah.
If you came here looking for the national champions, the safe, systemically important companies, you've taken a wrong turn. Or maybe you just missed the last deep dive.
Today we are opening what we call the classified file. We're shifting entirely from, let's say, conventional investment strategy into the highly specialized field of extreme risk management.
Right.
Our mission today is not to find you a stock you can, hold for 10 years and forget about. Our mission is to perform a forensic audit on the most dangerous, yet potentially most rewarding corner of the resource market.
And that's the key distinction, isn't it? We're leaving the world of, steady, reliable tractors, and we're entering the highly unstable cockpit of a fuel-injected drag racer.
Laughs. That's a good way to put it.
This is not casual investing. These are what the smart money calls asymmetric bets. Essentially, they're lottery tickets, but they're built upon a very precise, often existential, geological or strategic thesis.
And we are treating this whole process like a bomb disposal manual. I mean, when the stakes are a 10x upside or, total ruin, you need to know exactly where the pressure points are.
Exactly.
For each of the tickers we're going to examine today, that's Energy Fuels, UUUU, Critical Metals Corp, CRML, and USA Rare Earth, USR. We need to identify the fuse, the explosive charge, and the specific tripwire that could either launch the stock into orbit or see the company liquidated.
And that acceptance of total loss, that high-risk, high-reward calculus, I think that's what makes these names so fascinating. Why, despite their extreme volatility, are these companies watched so obsessively by some of the most sophisticated institutional investors out there?
Well, because they hold critical, very specific assets that the modern economy and, frankly, national security just cannot function without. We're not talking about generalized mining here. We are talking about foundational assets. We're talking about the only licensed uranium processing facility in the United States, major, heavy, rare earth deposits rich in the elements you need for the highest performance magnets, and potentially the world's largest undeveloped resource deposit for key critical minerals.
The upside is just. It's undeniable. If these management teams can successfully bridge the financing gap, if they can overcome the technical hurdles and actually bring these assets online, the return could be legendary.
It could be 10x, 20x, maybe even more. They could fundamentally reshape the domestic supply landscape for critical materials, and they could do it almost overnight.
But the downside is equally clear and very immediate. If they fail to secure the billions in financing they need, or if the complex, unproven chemistry just doesn't work out at scale,
then the asset becomes worthless. The company could absolutely fail. The stock could easily drop 50% or more in a single week on news of a project failure or a failed capital raise.
So we have to be perfectly clear before we open this file. If you are someone who cannot handle seeing a 70% drawdown in your portfolio, this information is for intellectual curiosity only.
Right.
It's for understanding how the most speculative frontier corner of the market operates, because this deep dive is, it's entirely focused on managing extreme danger.
So let's begin the audit with ticker number 1, UU Energy Fuels, Inc. This is, in many ways, the most perplexing company on the board. We call it the frustrating giant.
The frustrating giant, I like that.
Yeah, because it possesses such an immense, almost monopolistic strategic advantage, yet it constantly disappoints long-term investors, and it's all due to one specific recurring internal management practice.
Okay, let's unpack that frustration. The strategic moat they have is, frankly, almost unmatched in the critical minerals space in North America. People call it the Swiss Army knife of American critical minerals. But what gives them that truly unique status?
The bombshell, the asset that underpins everything, is the White Mesa Mill located in Utah. If you are building a strategic case for critical minerals in the U.S., you start, and you often end, with White Mesa.
Why there?
It is the only currently licensed and operating conventional uranium mill in the entire United States.
The only one.
That fact alone is massive. But the implication of that license is, well, that's the real secret.
And I imagine when we're talking about critical minerals, especially anything involving nuclear fuel or radioactive materials, permitting is the ultimate bottleneck. It's the gate that determines who gets to play and who doesn't.
Exactly. You cannot overstate this regulatory moat. If a competitor wanted to build a brand new uranium and rare earth processing facility in the U.S. today, they would be entering an environmental and regulatory maze.
How long are we talking?
You're looking at a permitting and construction timeline that could easily span a decade. 10 years.
10 years.
10 years of environmental impact studies, community approvals, regulatory sign-offs from multiple federal agencies, and then, the inevitable litigation that follows.
A decade is an eternity in the resource world.
Mm.
So UU, by owning White Mesa, they bypass all of that. The time, the capital, the regulatory risk.
Yeah.
It's all gone.
Completely. They own the mill, they own the permits, the infrastructure, and crucially, the long-standing community relationship. It's an asset that's worth billions that no one can replicate quickly.
And that infrastructure has adapted over time, right?
It has. The true strategic value isn't just that it handles uranium. It's the facility's expanded capabilities, what we call its triple threat capability, that elevates it to frankly, a national security asset.
Okay, let's detail that. What are the 3 materials White Mesa can currently handle that make it so pivotal?
First, obviously, is uranium, which is essential for our domestic nuclear power fleet. That's its bread and butter. Second, they can process vanadium. That's a crucial metal used in high-strength steels for aerospace and specialized battery technologies for grid storage. They're one of the few places that can efficiently pull this co-product out of the ore they process.
And the third threat, the one that really caught the eye of the U.S. Department of Defense and other government agencies, is the monazite processing. That's what unlocks the rare earths.
Correct. They've successfully retooled White Mesa to handle monazite sands, often sourced as a byproduct from established operations, say, in Brazil. This allows them to separate out the valuable rare earth elements.
So if the U.S. industrial complex or the military supply chain wants a reliable, immediate domestic supply chain for nuclear fuel or key rare earth elements tomorrow.
UU is the only operational large-scale game in town. Their ability to process material from others, not just from their own mines, makes them the immediate domestic solution.
That asset description, it sounds like a complete slam dunk. A strategic monopoly.
So let's go back to the source of the frustration. If the asset base is that strong, why does the stock remain such a frustrating trade? Why is it so hampered and volatile?
And that brings us to the core issue, which we call the constant leak, the ATM program.
The ATM program.
The at-the-market offering. This is the primary mechanism preventing the stock from reflecting its true strategic value. Rather than doing a massive traditional secondary offering where they sell 100 million shares at once and crash the price.
Which would be very visible.
Very visible. Instead, management elects to sell new shares directly into the public market, often daily, sometimes hourly.
It's like a cash register that's just running quietly in the background every single day the market is open, continuously generating cash for them.
It is, and the irony here, the thing we call the financial paradox, is that UU often already maintains a remarkably strong balance sheet. They typically hold well over $100 million in unrestricted cash. They are not facing imminent bankruptcy. So they're not cash-strapped in the traditional sense.
No, not at all. But management is perpetually capital intensive. They continuously pursue growth, strategic diversification into new elements like rare earths, and they maintain these non-core assets that burn cash while they wait for the uranium market to fully recover.
So they're always looking ahead.
They're always looking ahead, which requires a constant influx of capital to fund that vision, and this lets them avoid taking on high-interest debt.
Okay, but I have to challenge that point, because a listener could argue, isn't using an ATM program actually financially responsible? Doesn't it let them raise cash at the highest possible market price every day, avoiding a deeply discounted debt round or some massively dilutive single offering?
And that is precisely management's argument. From a purely corporate finance perspective, it has merit. Raising money daily, bit by bit, is less costly than high-interest debt, and it does avoid a single dramatic dilution event. But from a shareholder perspective, it is actively hostile. The subtle daily dilution creates a permanent supply overhang. It essentially places a stock price lid on the ticker.
Walk us through the mechanics of that lid. How does this daily drip of new shares actually impact the day-to-day trading for a long-term holder?
Okay, so imagine a fundamental analyst or a hedge fund decides UU is undervalued at, say, $6 a share. And they start accumulating. Their buying pressure begins to push the stock towards $6.50.
Right, as it should.
But the moment that demand attempts to push the price up, the ATM program is triggered, and a new supply of shares, sometimes millions of dollars worth, is immediately dumped onto the market. That daily supply absorbs the incoming demand.
So the demand that should be pushing the price up is just met with new supply from the company itself.
Precisely.
It's like trying to fill a bucket that has a pinhole leak.
Yeah.
A leak that gets slightly bigger every time you pour more water in.
That's a perfect analogy. This means the stock cannot achieve true, sustained liftoff, even when major positive news hits, like a huge new supply contract or a major commodity price spike. The management is selling into that strength, diluting the existing share count, and capping the stock's ascent just when investors expect to be rewarded.
And dilution, especially when it's continuous like this, is just lethal for long-term holders.
Yeah.
So for our listeners, let's just reiterate this. When the company issues new shares, your percentage ownership slice of that incredibly valuable White Mesa mill, it shrinks, even if the overall value of the mill stays exactly the same.
It's the ultimate paradox of the frustrating giant. You own a strategic monopoly, the only licensed mill in the country, a foundational piece of American energy security. But you are simultaneously fighting a management team that loves to use the stock as its personal ATM to fund its ongoing vision.
Constantly eroding your share of the enterprise.
Constantly.
So the conflict is clear. Management is playing this strategic long game building a diversified empire, and they view the stock primarily as a low-cost source of capital.
Right. And investors just want the stock price to reflect the strategic value of the mill, unencumbered by all that daily selling pressure.
The verdict on UU, then, is that it's an essential asset, a geopolitical must-have, but it is poisoned by this perpetual dilution risk. Any allocation to UU requires a level of diligence that goes way beyond reading headlines.
It requires meticulous quarterly monitoring of one specific metric, which we'll cover in the risk playbook section.
Okay, so that sets up our first risk profile, the constant self-inflicted wound of dilution. Now, let's pivot to a completely different type of risk. The existential financial pressure facing our second high-stakes play. Our second classified ticker is Critical Metals Corp, CRML. And if UU is a slow, frustrating leak, CRML is a high-stakes, externally pressured financial time bomb. The story here is defined by a massive, really aggressive strategic pivot.
That's right. When you look at the company's history, their old identity is now it's secondary. They started as a relatively small European lithium play focused on the Wolfsburg project. That was the original thesis.
Yeah.
But that asset, while it's valuable, it doesn't move the needle for a 10x type of bet.
The true game changer, the explosive charge, is the acquisition they announced in mid-2024, a controlling stake in the Tanbreez project in Greenland.
And this asset instantly changes the company's trajectory and its risk profile. It elevates it into potential global dominance.
When we talk about potential, we need to use terms like world-class, I assume.
Oh, absolutely. Tanbreez is arguably the largest rare earth deposit discovered on Earth. We are talking about scale that could potentially eclipse established dominant producers like MP Materials Mountain Pass in the U.S. The sheer volume of resource is just staggering.
But in rare earths, volume doesn't mean much without quality, does it? A lot of large deposits are just rich in the common, less valuable light rare earths. Where does Tanbreez stand on quality?
This is where the asset becomes strategically critical. Tanbreez is crucially rich in the heavy rare earths, specifically dysprosium and terbium. These are the elements that are incredibly difficult to source outside of China and are absolutely essential for high-performance technology.
Okay, explain that. Why are dysprosium and terbium, di-NTB, so vital? Why are the Pentagon, Tesla, and Siemens all desperate for a non-Chinese source of these specific elements?
Well, it all boils down to performance in extreme conditions. Heavy rare earths are used to create the permanent magnets that you need in high-efficiency electric vehicle motors, wind turbines, precision-guided weapon systems, high-temperature defense applications.
The top-tier stuff.
The top-tier stuff. Dysprosium, for example, is added to the magnet alloy to maintain its magnetism at high temperatures. It prevents motors from seizing up, so if you want a fighter jet or a premium EV that performs under stress, you need a secure supply of heavies.
And given the extreme concentration of that heavy rare earth supply chain in China, finding a massive, high-quality, geopolitically secure deposit like Tanbreez is, well, it's monumental.
It is. This asset is the core of the 20x potential for CRML. It could transform them almost overnight into a global rare earth giant.
Okay, so that's the reward. That's the charge in the bomb. Now we have to look at the financial structure that houses it.
And this is the problem. This colossal reward is currently housed inside a financially fragile shell. That's the severe financing risk. CRML went public via a SPAC merger with a vehicle called Sizzle.
The dreaded SPAC structure. For listeners who might need a quick refresher, a special purpose acquisition company, a SPAC, often raises capital based on hype, not proven revenue. What happened to CRML post-merger?
The standard post-SPAC fragility. The merger was followed by high redemptions.
Redemptions.
To explain that simply, the institutional investors who originally put cash into the SPAC shell, they often have the right to pull their money out if they don't like the final merger target. In CRML's case, many investors redeemed. They took their cash back instead of holding the CRML stock.
So the company might have expected a war chest of, say, $500 million, but because of these high redemptions, they ended up with just a fraction of that. It left them cash poor.
Exactly. They have low tens of millions in the bank. I mean, that's a small budget for some preliminary exploration. Meanwhile, they own Tanbreez, a project in Greenland that requires billions to bring online. Mining in the Arctic Circle requires massive infrastructure, investment ports, roads, power generation, and very specialized processing facilities.
That funding gap, the difference between the tens of millions they have and the billions they need, that is the fuse on this entire operation. It represents the certainty of extreme dilution.
It's guaranteed. There is no scenario where this mine gets built without issuing massive volumes of new shares or selling a substantial portion of the project itself.
So just to do the initial work.
Just to fund the preliminary infrastructure and the detailed feasibility studies alone, which will cost hundreds of millions, they have to sell shares. When they get to the final investment decision, they will need a strategic partner or a massive, highly dilutive equity raise.
So unlike UU, where management chooses to dilute to avoid debt, CRML's dilution is mathematically guaranteed by the sheer scale of the capital raise they need. The only questions are who they sell the shares to and at what price.
And that brings us to the management and control concerns. The CEO, Tony Sage, has been described by some sources as a promoter, which suggests his focus is primarily on deal-making and capital raising rather than strictly, mine development and operational excellence.
And the risk profile of this management team is amplified by the fact that Sage controls the vote. He has a massive personal stake through an entity called Rimble. How does that structure impact the minority shareholders, especially during a guaranteed dilution event like this one?
Well, when a company is desperate for billions, the person who controls the vote can dictate the financing terms. If a massive new investor comes in, they're going to demand very favorable terms, often at the expense of existing shareholders.
Because the little guy can't do anything.
The minority shareholders lack the leverage to fight highly dilutive capital raises if the controlling stake is aligned with that financing structure. So this makes CRML not just a financing risk, but a major wild card based on governance and control.
So the ultimate risk is that Tanbreez, this world-class asset, just gets trapped in a perpetual financing cycle, a death by 1,000 cuts. They raise just enough cash to stay alive and complete the next study, but they never secure that final billion-dollar commitment they need for actual production.
The verdict on CRML is pretty clear. It's a world-class asset inside a financially fragile shell. It has an astronomical burn rate, and the risk is entirely tied to the announcement of a strategic partner who's willing to inject foundational capital.
And
until then, you are betting on a deal flow that requires billions of dollars.
Okay, so we've covered the risk of the slow leak, that's UU's dilution, and the risk of the financial fuse burning out, which is CRML's funding gap. Now let's look at the third classified ticker, USR, which combines an unproven scientific experiment with a guaranteed structural collapse.
USA Rare Earth, or USR, represents a completely different kind of dual risk. It is one part fundamental technical hazard and one part structural market hazard. And like CRML, USR also chose the SPAC route, merging with Inflection Point, IPM, so it's now a de-SPAC company.
Okay, let's focus on the prize first. The domestic dream that drives the entire valuation. Their main asset is the Round Top project in Texas.
Round Top is positioned as the domestic answer to the supply chain crisis. Like Tanbreez, it's a world-class heavy rare earth play, offering the critical dysprosium and terbium.
What makes it unique?
What makes Round Top truly unique is its resource co-products. It also contains significant amounts of lithium and uranium, all within the same geological structure.
Wait, a single domestic site that can supply magnets, battery metals, and nuclear fuel. That sounds incredible.
It is. It fulfills the geopolitical goal of creating a 100% domestic U.S. supply chain for high-performance magnets and critical materials. This is what you hear referred to as the Pentagon's dream, a fully integrated, secure, domestic source.
The potential is an empire.
It is. However, we immediately run into risk one, the technical hazard. And this risk is rooted entirely in geoscience and chemistry, not finance.
Okay, so this is the part of the story that sounds like a massive scientific experiment. What makes the geology of Round Top so unique, and why is the processing so risky?
The deposit type is known as rhyolite. So you have a massive mountain of unbelievable tonnage, but the actual rare earth elements are distributed throughout that immense volume at a very, very low grade.
Oh, great.
Very low grade. To put this in perspective, you have to process exponentially more rock than a typical hard rock mine just to get the same amount of final product.
And low grade is often a killer for profitability. And I imagine when you combine low grade with unique geology, you need specialized and often complex processing techniques.
And that brings us to the crucial technical hurdle. The elements are chemically bound inside this rhyolite rock in a really complex way. The process needed to separate, leach, and purify these elements efficiently and economically. It has never been successfully executed at a commercial scale anywhere in the world.
Never.
Never. This is not a slight optimization challenge. This is a fundamental technological and chemical test.
Okay, let's use an analogy here to drive this home for the listeners. This isn't like digging up a gold nugget. This is more like trying to find microscopic flakes of incredibly valuable material hidden inside a billion tons of gravel.
Right.
And then realizing you need a custom-built experimental acid bath, which may or may not work economically, to dissolve all that gravel and extract the flakes.
That is the USR bet in a nutshell. If the chemistry works, and it works cheaply enough to be profitable, they unlock one of the world's most significant domestic resource complexes, and the empire is built.
And if it fails?
If the chemistry fails, if it's too costly, too slow, or simply ineffective at getting the necessary purity, the resource is essentially worthless. The entire mountain remains a scientific curiosity rather than a revenue generator. It's a binary, all-or-nothing operational risk.
Wow. Okay, now let's pair that technical unknown with risk two, the structural hazard.
Yeah.
This is the predictable disaster known as the SPAC Curse.
The SPAC model is inherently built to flood the market with shares held by early sponsors and pre-merger insiders. These shares are acquired at highly favorable, low valuations, often for, pennies on the dollar before the merger is even announced.
But there's a catch, right?
The catch is that these shares are subject to a lockup period where insiders cannot sell for a set time, typically 6 months to a year post-merger.
And I assume the market, being hyper-efficient, knows exactly when that lockup period expires.
It does. The lockup expiry date is publicly filed, and it's meticulously tracked. The moment that date arrives, the market anticipates a massive supply shock. Why? Because the early investors who got their shares for next to nothing are now legally allowed to sell millions of them and take huge profits.
So the company's stock can crash by 50 to 80% in its first year, not because of bad news about the mine, not because the chemistry failed, but purely because of the structural mechanics of insider selling pressure.
Absolutely. The crash is predictable and it's structural. It is the moment the supply dam breaks. The smart money knows the selling pressure is imminent, and they price it in by selling before the lockup expires. They avoid the inevitable dip.
Which means USR investors are dealing with two things at once: the technical unknown, about the chemistry work, and the structural known, that the stock is likely facing guaranteed immense selling pressure when those lockup periods expire.
The verdict on USR is that it is the ultimate operational and structural wildcard. The domestic dream is palpable, and the rewards for success are enormous. But until that chemistry is proven at commercial scale, and until the structural overhang of the cheap SPAC shares is cleared and absorbed by the market,
It's a falling knife.
this stock remains highly exposed to two completely different, equally devastating hazards.
Okay, we've thoroughly dissected the bombs, the constant dilution risk of UU, the financial fuse of CRML's funding gap, and the binary risk of USR's untested chemistry in the SPAC structure. Now, we shift entirely to the playbook, controlling the blast radius.
This section is the core of our bomb disposal manual. When you're dealing with highly speculative resource plays like these, traditional technical chart analysis, looking for support or resistance lines, is largely irrelevant.
It's pointless.
It's pointless. Management decisions and financial structures completely overpower market sentiment.
Exactly. When management is dumping shares via an ATM, or when insiders are waiting to sell massive blocks, the only things that truly matter are the fundamentals related to corporate financing, ownership structure, and governance. This is the smart money checklist for minimizing the risk of ruin.
Let's start with UUU, the frustrating giant, and the key metric for survival, the dilution watch. This requires active diligence every single quarter.
We established that the core issue is that at-the-market program. So how do we track the impact of the ATM?
You have to disregard typical financial metrics like PE ratios. You need to focus religiously on one single number published in the quarterly 10Q or the annual 10K filing: shares outstanding.
Shares outstanding.
This number tells you precisely how much the company is expanding its share base and how quickly your ownership slice is shrinking.
This is critical, actionable advice then.
Yeah.
Do not simply buy UUU because the uranium or vanadium price has spiked. If the share count is rising just as fast as the commodity price, you are just running on a treadmill. Your capital is being diluted in real time.
The rule is simple and it's harsh. If the share count is rising significantly faster than the company's actual sustainable operating revenue, you are fighting a losing battle against a management team that's selling into strength.
So when is the time to look at it?
The entry opportunity arises only when the company announces a definitive halt or at least a significant slowdown to the ATM program. That is the moment true market demand can lift the price without that immediate countervailing supply from management.
Okay, next. Let's look at CRML, the Greenland Giant, and the financing watch. This is purely about an external capital injection that validates the project.
Given their cash-poor post-SPAC status and the multi-billion-dollar requirement for Tanbreez and the challenging environment of Greenland, you have to operate under the assumption that the company is running on fumes until external non-dilutive capital arrives.
Right.
Their burn rate means they have a finite amount of time before they are forced into massive, potentially catastrophic dilution.
So if I'm a speculator, I shouldn't be excited by a press release about a good drilling result or a favorable assay test. That doesn't actually reduce the risk.
It doesn't reduce the financial risk by $1. The trigger that de-risks CRML is the announcement of a strategic partner. We are talking about a major entity, a government agency like the European Union or the U.S. Department of Defense, a massive industrial user like a global auto manufacturer, or a well-capitalized sovereign wealth fund.
A partner with deep pockets who's willing to inject the necessary capital, not just for a small exploration phase, but for the fundamental multi-year, multi-billion-dollar build-up.
Correct. And that partnership isn't just about money, it's about validation. It means the billions required for the mine are now credible, the regulatory risks with Greenland are being shared, and the project has a committed customer base.
So if a partner steps up,
If a strategic partner with a long-term vision steps up and commits, say, $500 million toward infrastructure, the risk profile of CRML drops dramatically. Until that press release hits, you have to treat the stock as highly volatile and prone to a sudden collapse if financing efforts fail.
and finally, USAR, the heavy earth bed. Since this is a de-SPAC, the focus is entirely on managing that structural hazard, the lockup watch.
You need to pinpoint the exact lockup expiry dates. These dates are often found buried deep in the S1 or the proxy statements, and they dictate when the original SPAC sponsors and pre-merger insiders are permitted to liquidate their blocks of stock.
So this is the most important date on the calendar.
It is arguably the most critical and non-negotiable data point for any de-SPAC investment.
And the strategy here is tactical and pretty cold-blooded. Smart money recognizes that the price is going to be structurally depressed leading up to and immediately following this expiry date because the market is just anticipating that flood of sellers.
They wait. They allow the early insiders, the people who got in at valuations that were orders of magnitude lower than today's price, to sell their shares and exit the investment.
So you wait for the blood in the street.
You wait. Only once that predictable structural selling pressure subsides and the stock shows definitive signs of finding a stable price floor after the expiry date, does the smart money even consider entry. If you buy before the lockup expires, you are simply serving as the exit liquidity for those cheap insiders.
This entire forensic audit of risk leads us directly to the single most important rule for surviving on this frontier. If our mission is controlling the blast radius, this is the master safety switch. The golden rule of sizing.
Position sizing is your only defense against zero. The rewards are huge, but the risk of failure, geological, technical, or financial, is fatal.
So what's the number?
If you allocate more than a maximum of 2% of your total portfolio to these three stocks combined, you have moved beyond responsible speculation and into outright gambling. That number has to be sacred.
2%. That's it.
Think of it this way. If UUU, CRML, or USR goes to zero, which, again, is a legitimate, tangible possibility for all three due to the risks we've detailed, you lose 2% of your overall capital. Your life continues unchanged.
You take the loss, learn the lesson, and move on.
Exactly. But if you allocate 10 or 20%, you are guaranteeing financial disaster if the project fails, the chemistry doesn't work, or the financing falls through.
So sizing is the difference between a highly leveraged speculation that can make your year and an overextended bet that can break your financial life. Your protective gear in this volatile arena is the disciplined enforcement of that small position size.
So we've dissected 3 of the highest risk, highest reward resource plays currently driving the chatter in this sector. This analysis, I think, exposes the harsh reality of the resource war.
Which is,
Raw materials are essential, global supply chains are brittle, and some companies will successfully build the foundational infrastructure for the future.
and crucially, many, many others, often those with the most ambitious plans, will go bankrupt trying to bridge that immense gap between geological potential, which is what they own, and commercial reality, which is what they must execute.
That gap is where most capital dies.
So if you choose to enter this arena, your final instructions must be based on relentless, active due diligence. This is not a set-it-and-forget-it investment.
Not at all. You have to read the quarterly filings, specifically the cash flow statements, and watch that share count rise or fall. Monitor the cash burn obsessively.
And we have to deliver the stern warning that this risk profile demands. The potential rewards here are, yes, they're legendary. A 10x return has the power to redefine a portfolio.
But the specific systemic risks we detailed, management dilution, untested chemistry, structural SPAC overhang, these are existential risks. They are company killers.
So if you cannot afford to set this allocated capital on fire, if you can't handle a 70% drawdown without immediately panic selling, then step back.
This knowledge is your protective understanding of the market dynamics. Use it to inform your strategy, not as a mandate for reckless action. Wear a helmet.
We spent a lot of time comparing the different types of risk. The risk inherent in management decisions, like you use dilution, versus the risk inherent in the market and in nature, like CRML's massive funding gap and USAR's unproven chemistry.
And this contrast between internal controllable risk and external uncontrollable risk, that leads us to our final provocative thought for you to mull over as you consider these extreme asymmetric bets.
The ultimate trade-off in these speculative resource plays is between the steady, chronic erosion of value and the sudden, acute destruction of value.
Which is the greater unavoidable risk that you should size your position against? Is it the certainty of management-driven dilution to fund ongoing operations, that slow leak that shrinks your share of the pie month after month? Or is it the uncontrollable, external, market-driven volatility of a global commodity price crash? A tidal wave that can erase 50% of your value instantly, regardless of how well management is performing internally.
One is a continuous drag you can meticulously track. The other is a black swan event you can only brace for.
That fundamental conflict, internal dilution versus an external market crash, is the strategic conundrum every speculator in this field has to solve when they place their bet.
Consider the implications of both. Assess your own risk tolerance and then size your positions accordingly.
Thank you for diving deep with us.